Good to have you here on MyStockScanner Live. December is where smart investors stay disciplined, focused, and ready. Let's see which stocks finish the year strong. And remember, MyStockScanner Live is free and full of great information and tips for everyone from the seasoned investor and then to the beginner. So share this video or link or tag your friends so they can benefit as well. We not only have good stories, we also have great experts in finance. Hans-Henrik Nielsen, Liam Flavel are ready to answer your questions. You could send us one on FOMO at mystockscanner.com. And every morning, Hans-Henrik published a market scan. Hans-Henrik, it's a good start to the week. Sometimes you do paint a bleak picture. It's not all festive in your end of the world, but what's the main story today?
Oh, I think I was quite jolly and spreading good mood today. I basically said that Japan and US is going to hell, and that might make the stocks go up.
Yeah, see, that's how we start our week here on My Stocks Scanner Live. Liam, the week ahead is all about the Fed and the meeting on Wednesday. We will comment that live, or Hans-Henrik will on Wednesday. But for now, it seems like everybody's pricing in the rate cut, and that will determine that the investors probably going to get a Christmas rally. If not, is it coal, the little black lump for everyone?
It's a difficult one to call, really. I mean, odds on it's going to be a 25% or a 25-point basis cut. It could be more, it could be less. We just don't know. You got Powell going out of the Federal Reserve's chairman next year. He may just stick two fingers up at the Trump administration and say, we're doing it properly.
So it's not two cuts, he means. That's not it.
No.
Big fat zero.
We shall see. It comes on Wednesday, and as said, Hans-Henrik will be commenting on our social media. On today's show, we have stuffed your Christmas stocking with news about new stocks joining the S&P 500, the story about NVIDIA being beat out by discount stores in the US, what's all about. At least it's when it comes to stock value, that is. We'll also tell you that you should sell your Magnificent Seven stocks, or at least that's one analyst is thinking at the moment. And since it's Monday, we are going to open up the 3-point playbook portfolio, which is up 33.1% up the year. And finally, we'll dive into Netflix buying Warner Brothers. And then we have number of the day, a British one today, in that sense that it's 22.9 million pounds sterling. What that is in connection with, we'll tell you at the end of the show. But first, we're going to start out with the news that came on Friday. It'll go into effect on the 22nd of December. New stocks to join on the S&P 500. Hans-Henrik, why is that important at all?
Well, it is important because that a lot of funds, ETFs and so on, are tracking S&P 500. They're not trying to guess which stocks are good and bad. They are just mirroring the S&P 500. That means that the second a new stock is being let into S&P 500, there are billions and billions of dollars going into the S&P 500 every day, and some of that will be going towards that stock. That is at least the theory. There have been some thoughts about who it might be in advance, so they have gone up a bit. I can just take a very quick look at the three stocks that are getting in right now. There is Carvana, which is a stock we went out of, or at least we said we wouldn't touch a couple of years ago. But as we can see, it has actually started to do a bit better here. Another one is a comfort system called Fix. If we just look at them here, they are extremely stable growers. I do get why they are getting a place in S&P 500, definitely. And then we have an Irish. Didn't we figure out it was Irish? Which also is a stable grower. They are cement, construction materials, and all that stuff. We were looking at if we were interested in buying just one of them. And to be honest, Carvana, if we're looking at their valuation, there's some very good potential in here. There's one slight problem, and that is they're trading at a PE of 93, which makes it an absolutely no-go for us. But if you are a bit into high PE kind of stocks, then there's some potential massive upside here if the investors want to keep buying expensively. Looking at the fix here, Comfort Systems. Let's see, we should just have a look at this. That is a bit too expensive right now. There's simply too much downside compared to where investors have thought cheap areas were early on. If that drops down, maybe down to 750, 800, I might consider it. And with the CRH, of course, we wouldn't consider that since it's Irish. But let's just say for the example here's sake, it's actually not that. It's one of the best of the three. However, I would like it to drop a bit down towards 105, 108. Then it would be good value and a very stable grower.
I did some research on the company, and the secret of their special cement that they've got is they put Guinness in it. Brilliant stuff. Yeah.
Oh, well, it's not that big a surprise. Is there anything you don't put beer into?
No, it's always a waste when you don't put it into yourself, though. That's the only thing. So, yeah. Sorry, right. we're diversing.
Oh, yeah. You were saying, Jesper.
I wonder what was in your Christmas stocking this morning, because it seems like it might have been a Guinness in there. You guys are all giddy and all over the place. But again, when new stocks like this come into the S&P 500, do your due diligence. That's what we are trying to do. At least we normally do. Today, apparently not. But we look at what these stocks, what industry are they in. And Carvana, for instance, is a used car dealership, basically a big vending machine with used cars. That's what it can be described as.
Just mentioning on that, it is good to look at the macros as well. And right now, there are millions of used cars in US that are being taken back because people can't pay the loan. So it is a market that might crash a bit.
Okay, let's go cheap then, because one of the stories that came out this morning was that if you want to have a swing for your buck, then you better go cheap, in that sense that Dollar Store and Dollar General, or Dollar Tree is what's they're called, and Dollar General beat out Nvidia when it comes to stock growth. Liam, what's the story there?
They're better performers this year than Nvidia. So it's quite a surprise, really, for a lot of people. Again, we're coming back to the macroeconomics here. A huge percentage of the US population can't actually properly afford food and drink out of their, just to survive out of their normal paycheck. So that means that the cheapest stores always go up in this sort of situation. You tend to find that in recessions as well. So that's the story this year on the consumer side of things. If we look at the two companies, I'll just do a very quick 3-point playbook analysis. Yeah, the 3-point playbook we ask 3 key questions before we buy a stock, or to make sure we're allowed to buy a stock. First one is this a quality company? And you can see here the 3 key metrics I always look at, always go on about. Our quality score out of 100, it's 80. That's great. It's almost dark green on there. The earnings per share, even though it's lower than it was a few years ago, you can see that in these golden areas, the analysts are expecting it to start going up from last year, which was the lowest it's been for a while. So we're looking at the earnings and the profits starting to come through. And the last element I quickly glance at to see whether I want to look any further is the PEG ratio, and that tells us how much of the price has those enhanced estimates coming in. So that being below 2.5 is a great indication of a stock. Then we start looking a bit more. The analysts have increased over the last 90 days what they think the company is going to earn. The returns on equity and capital are okay. They're sort of starting to go down, and the free cash flow, the company's bringing in money and it's starting to accelerate in that way. And that's the first question. Yes, it's a quality company. From a valuation point of view, we can see I've matched the peaks and the troughs. The green is our peak, saying where could the stock go to? The red is the bear case, saying where could it go down to in the worst case? And then really sort of put the blue line normally either in the middle between them or somewhere around the analyst line. And we can see that actually there might be a 20% upside in the best case, but there's actually a 32% downside because the stock's gone up so much. So Dollar General, interesting, high quality, not really for us. Dollar Tree, you can see very quickly the quality score is lower. The earnings are a bit more stagnant, even though that's shooting up this year. We haven't got a PEG ratio because last year there were no profits. It was negative. Everything else, the returns are better. The free cash flow is pretty good, so not a bad one. If we just look at the valuations very quickly, we can see there's a little bit more upside, but this blue case is where we think it's going to be, and we tend to like this blue line to be double what this is. So we'd want to have a 40% upside on here to go into it with a 20% downside. So that's not for us either. So
if I just might add, I read a place that something about 80 to 90% of all their products were imported from China, so they might have taken a hit there as well.
There might be a little hit on the tariffs as well. But it's interesting that it was what the analyst compared to NVIDIA and said that the Dollar Tree and Dollar General was a better investment. And we have an article out that says that people are suggesting, or some analysts are suggesting, that you should get out of your Magnificent Seven stocks. And of course, this is the main brunt of the American Stock Exchange. Guys, what are you saying? Should we sell off everything that we have?
Well, we don't have much Mag 7, to be honest. Not in our portfolio.
No.
They have. I think we had in NVIDIA. Did we have Alphabet as well as a point, or were we just considering?
We were considering it. I don't think we've really touched them because they've been that expensive. So yeah, it's not a huge surprise. And actually, looking at I know our new stock map tool, they're all in a they're not in a great position at the moment, any of them, which is interesting.
But they are such a huge component of the stock exchange in the US. If the analysts are right and people are starting to diversify and go elsewhere, what's going to happen then?
Well, the first thing you've got to look at here is that the reason that everyone is saying we're not too sure on the future earnings from this is that Google, Meta, Amazon, NVIDIA and Microsoft are all spending huge amounts of money on the AI. And there's that big question mark now over it saying, where is AI going? Is it really going to be, as good as people say? Is it really going to get a return on investment on here? So NVIDIA is obviously getting the money in. The other companies are just spending like there's no tomorrow just to try and keep up with the others. So that's going to be the interesting thing. Maybe that means Tesla and Apple will be the winners.
Well, who would know? Don't get him started, Liam. Don't get Hans-Henrik started on this. I'd much rather ask our users, because the combined brain power of all our users are interesting in that sense that you guys do follow a lot of stocks out there. And we would like your take tomorrow in our Tuesday poll that we ask in all our social media groups. We will put up a poll, which one of the Magnificent Seven you like the best. We'll bring all seven to a test, and you can vote and tell us which ones that you like. But as a little, let's do an appetizer, an hors d'oeuvre. Liam, your favorite Mag 7?
I'm going to surprise you guys. I'm going to say Meta.
Okay.
They've really dropped recently, and I think they're not as bad as people make out. So, and they're using AI to generate ad revenue, and that's the core business that they've got, and it's working extremely well for them. So I think they may have been oversold.
Hans-Henrik, for sure, you're going to say Tesla.
Yes, that is the only company that is well priced in that. No, I'm kidding. I am going to say Alphabet.
And Google?
Yes. And the reason is that I think they're not being hit as bad on the search engine that was originally thought it to be. And then a year and a half ago, they were basically deemed out of the race of AI. They failed completely. And now they are actually one of the leaders with their new models coming out. And then I think there's a part that is completely overlooked by many, and that is their involvement in Waymo, the self-driving taxis.
One question I would like to ask you also, because it came in on the email just now, FOMO@MyStockScanner.com. Which one of the two Googles to invest in? Because there's two stocks. There's basically the A stock and the C stock. Does it matter which one that you take?
I would say no. It's something about is it no voting rights, Liam?
It's voting rights.
Yeah.
On the stock.
Normally, I think the retail trader choice is the lower of them. Meaning, if there is an A and a B, we normally choose the B, and A and a C, we choose a C. That is normally where there is the most volume, so you get the best pricing.
So there you had it, our experts' opinion. You will get to say yours when we have the 3-point playbook, or when we have the Tuesday poll tomorrow on our social media. The reason for that I mentioned the 3-point playbook portfolio is because that's what's next on the show here. We're gonna take a look. We're up by 33.1%. It seems like and we can say gladly that we are sort of staying at the same level right now. And that's a good thing when we come up towards the end of the year, because to end the end of the year and being 33% up, that's not a bad return on your investment. And guys, let's take a look at it. We had not a lot. We had a couple of souls and we had some boards last week. Take us through it. I know that you both are gonna talk about it, but Hans-Henrik, you start.
Yeah. First of all, down here, we can see how much of our money we have put into this. We have been around 55% for a while, meaning 55% of our money was into the market. That's gone up a bit now, and I am actually planning on seeing if I can find a couple of good stocks again. And that is a bit of what I wrote about this morning, with liquidity probably starting to pour into the market in the beginning of the year. That could lift the entire market, create a lot of inflation, but that is for another day. Yes, we did sell a couple of stocks last week, and one of them were Indra. Let me just find it here. And that is one where you could say that my exit might have been a bit premature. What we normally do, because Indra, it is a defense stock, it's all green, it's actually a really good company. What we could see with Indra was that the pricing were getting fairly high. And that means we are dragging our stop loss a bit closer up. In TradingView here, we can see that what happened on this day, it had gone red in our daily MTI. It had been down here testing, trying to get up, and then we went down quite significantly. At this point, we are considering, it breaks a green line, that is our 50 SMA, and we are considering, should we sell on this? The point where I sold, and I did sell at that point, was here. The next support level, we're down here around the 200-day moving average. That's 20% down. So that is what we are risking if investors are sending the price down to the next resistance area or support area. So I took it off here. And then, of course, the day after it started to turn around. I actually think if we're looking at just live prices here, I think it's going up even more today. So we might enter it again. And that is what we often do.
I was going to ask Hans-Henrik, because it's no secret, and Liam, you can chip in on this one as well, that Indra has been a stock that you've been in twice in that sense. So you're not afraid, you're not shy about going back into a stock that you went out of.
No, I mean, we're just following the trends, following the momentum. So you can see this is a really good example of the green 50-day SMA that Hans-Henrik's got on his screen there. That green line is just it works really well from our momentum point of view to say, okay, if a stock is still above its 50-day, it's still going up. It's still in an uptrend. We don't sell when it's in an uptrend. It's only when it looks like it's starting to breach that 50-day or our MTI indicators that are actually on the platform start going red. That's when we start switching over to say, okay, now we need to be aware that there could be a good reason to sell here. And that's where Airbus came in actually on our side of things. That if I just you want to search for it and go into TradingView, so Airbus we sold last week, went into it at the beginning of September. And this is a good example of where we exited because it broke. There are two things here. Went in there, we were doing fairly well out of it, and then sort of they forgot to, I don't know, bolt on a tail fin or something like that onto an airplane, or the software they had to update. So it was a big scare. There were 2 software update scares last week for Airbus, which dropped their stock down quite a lot. That gap down, which is that gap between sort of where there and then sort of the next day. The gapping down is always a bad thing in our testing, and then it broke the 50-day, so that was it. We sold.
It's interesting because Hans-Henrik, I'm going to bring in Billy wrote us an email at fomo@mystockscanner.com, and he's one of those guys that sometimes, you get caught if you don't sell on the day, what to do. He has a couple of things that right now follow the 200-day SMA or the 50-day SMA. I know we can't give direct sort of pinpoint advice for a guy like that in regards to specific stocks, but there's a rule about your strategy when you enter a stock and also when you exit it.
Oh yes, and we have the 50-day SMA, the 50-day moving average here. As you can see with Airbus, we actually gave it a bit of room to run on because it did move down here. Then it met a support area and tried to get up, and then we sold just when it broke here. And this is a good example. It just continued deeply down, and now it's trying to figure out what it wants. The question he asked is, if I didn't get out there, should I then use the 200 SMA, or what should I do? And I can't give a specific answer to this because it's a lot about how you are as an investor and as a trader. If you want to trade less often, let me just zoom out here. Let's say you buy when it's above a 200 SMA. As you can see, you are in the trades a lot longer here. But when it goes wrong from a top to a bottom, there is a lot larger of a drawdown. So I can't give an exact rule for this. I can say what I do, and if it breaks the 50-day SMA and there is a support area just close to it, I am giving it a bit of room. As with Intra, there were no support area, so I sold it when it dropped down through the 50-day SMA. Then it turned around, and that is what happens. That's just part of the math.
That's just part of the math. I'm sure that Netflix did their math when they put down an offer of $72 billion for Warner Brothers, and they kind of, I won't say won the auction, but there was a guy in the White House who kind of said, not so fast. He's gonna put himself into that deal. Trump said, not so fast, Netflix. What is that going to do to the stock prices? Because right now, Netflix went down. They're going to spend a lot of money. Warner Bros. Went up because they were bought. So that's the normal sort of feeling to it. What happens now? What happens now?
Who knows? I mean, with a master of the deal like the Trump guys coming in, then obviously it's going to work out quite well for them, I'd imagine. And there might be brown paper bags of cash sort of exchanging hands somewhere, maybe. Who knows? Netflix. I mean, you say they were going down. They were going down anyway. They've been going down since June. Yeah. As we can see here, they peaked up here, and that's where I put my green line on the valuation chart. And you can see I've said it. It's difficult to tell with this one. It could be up here, it could be down there, on the worst case scenario. But let's say the worst case scenario is here. It's not a bad buy. Actually, once it starts turning around, we wouldn't actually do it now. So it's a quality company. I won't go through the playbooks, but what I will say is that we wouldn't touch it until it breaks above its 50-day and probably the 200. And these two MTI lines go green. That's what
have a look at when it broke the 50 SMA back in July, and what it has been doing since.
Yeah, so we'd have come out here. Or maybe here on this red line here, probably, if we gave it a bit of room. And that's what we're talking about. It breaks the trend. It's no longer in that uptrend. Therefore, it could still go back up. We'll buy it. If it doesn't, we're out. We're safe.
It's definitely one of those things that I will say to everybody: hold your horses right now, because you never know what's gonna happen. Whether it be brown bags or a Fabergé egg, it might be that's needed to get this deal through. Who knows? Because the number of the day, 22.9 million pounds sterling, was what was paid for the winter egg here in last week in an auction in London. As a matter of fact, $22.9 million for a Fabergé egg. And you might ask yourself, how many Fabergé eggs is out there? The answer to that is 69. A couple of them are gone missing. 2 of them are known to have been broken. There's a Danish egg from 1903. That was number 19, part of the Russian Tsar's collection of 50 eggs. And then there's 7 Kel's eggs and 12 other known eggs. And not a word more about that. Let's look forward to Wednesday. We get the rate decision from Jeremy Powell. But we'll also get some earnings this week. And I'm going to put the 2 of you on the spot. Liam, you first. Tomorrow we're going to have Aero Environmental. That's another defense stock. What's going to happen? Is that going to push the defense stocks market or what?
It could do. I was looking at it. We haven't got time to show it on the value chart, I don't think, but it looks like a really good stock. So I think it's one we might talk about a little later and see whether it's worth going into it. We wouldn't go into it before earnings, but once it's out, then the peace plan, whatever it is, whatever stage it's at the moment, it's difficult to tell, isn't it? Could have a massive effect on the company. But I think the world is going to be a disorganized and quite dangerous place for the next few years. So I can't see it drop. I can't see it negatively affecting it too much.
Okay. Hans-Henrik, you and I are going to talk Danish from Wednesday at noon because changes are coming to our little show here in that sense that we're going to do more.
Yeah. 5 days a week in Danish, and then a couple of times per week in English. So
that's going to be the setup every day from Wednesday at noon. We're going to do a Danish show, MyStockScanner live, and then on Tuesdays and Thursdays we're going to bring in Liam at 1:00. So there'll be 2 shows on Tuesdays and Thursdays, one in English at 1:00. You have that to look forward to. Be sure to shower us with your questions at fomo@mystockscanner.com, and we'll take them up on the show as we go along. Right now, we are at the end of the show today. Remember to share this show with your friends. It's free and full of great information and tips. So tag them or send the show to them, or I'm almost going to say tell them about it and let them get in on the fun. We will see each other on Wednesday at 12:00. Until then, happy investing. Take care, guys. See you.
Bye.